What impact has all the additional liquidity that has come into the market over the past decade had on the returns that you can generate out of bonds? What's that environment been like for you?
Yeah, so I guess there's a few aspects to that. I mean, the first thing that's done is it's compressed yields downwards. So the first impact that has is it gives great, very high returns from bonds because you get the capital gain from the interest rate coming down. And that process has continued and continued, so we continue to make new lows in yield. Of course, now that the cash rate's lower too, the sort of baseline is lower, not just for fixed interest and bonds, but for all asset classes really, because the lower you're starting with that low, everything's kind of linked to the sort of cash rate in terms of its expected return.
Yep.
So yeah, it compresses. But the other thing it's done, which has been quite interesting, actually, perhaps not so much the quantitative easing, the excess liquidity, but the regulation that I was talking about a little bit before. That extra regulation on banks has created lots of new opportunities for investors in the style of investing that we do, which is relative value.
Right.
Because it used to be that the banks with their proprietary trading operations could capture a lot of the opportunities that we now capture. So they've stepped aside and left it to the likes of us to take advantage of those opportunities. So it's actually been a very good environment, and I think will continue to be because of that.
So excusing my lack of knowledge, but can you give me the 101 on what relative value is in this space?
Sure. So relative value is the idea that you've got all sorts of different fixed interest investments and derivatives. And the idea is that amongst all of those, you pick the best value ones and you hedge them by short selling the expensive ones.
Okay.
And then when that converges, you can trade out of it and take a profit.
Right.
And there's an unbelievably wide array of different investments that you can do that with. And so the opportunities are always there. They're always coming and going, and through different market environments, and it takes the pressure off you to try and predict things that are very hard to predict, like the direction of interest rates, whether economies are going to go into recession or
well, we're
boom.
Going to ask you to predict that anyway, so we're going to get into that.
I'm happy to have a go, but our returns don't depend on us getting that right. We're not, because we know that it's very hard. And we sympathise with the people who do rely on that because we know it's that hard. We just focus on that, just that relative value piece, which is much more reliable in our view.
So, what was the appeal of fixed income for you, as fixed interest for you? As you were starting your career, like why did you want to get into this space?
Well, look, I started working for Credit Suisse at the beginning of my career, and I just found markets fascinating. There's always these interest rate markets always being driven by world events, so you feel completely plugged into what's going on in the world, and then there's this amazing breadth of opportunity in the market to trade, and I think what most people don't realise is just the volume of trading and the size of the bond market itself. Even in Australia, it's enormous. The borrowings that the government have to undertake are quite large, and they create these bonds, and you can then trade them. And it's a fascinating sort of opportunity. And then those same opportunities exist in other markets. And then, as I was mentioning before, it's not just the bonds themselves that you can trade. Also, there's a whole large derivative market around fixed interest that you can also look for opportunities.
Mm. During your sort of the career, and when we speak to investors, we often hear about influences and mentors and stories that shaped how people invest. How would you describe your approaches, your philosophy as an investor? And is there a story or a person that sort of you can draw on that sort of shaped a little bit about how you think? Yeah,
look, actually there is. Because as I've just finished explaining, it's relative value is the approach that I ended up making really my approach, and investment philosophy was around that. And I guess perhaps what led me to become so keen on that was my first boss, who was an economist, and he was very strong on the efficient market hypothesis, where he explained that what the efficient market hypothesis does is it says it's very, very difficult to find consistent, reliable ways of making a profit in the markets. Because the markets are so efficient, there's no easy opportunities there. You can make money by taking more risk, but it's own, there's no risk-free money, I suppose. So now, the efficient market hypothesis is not exactly true, but there's big parts of it that are true. So in other words, the market is not completely efficient, but it is pretty efficient.
Yeah.
So like, just to give you an example, in terms of trying to predict the direction of rates, using bond markets to predict the, take bets up or down, very difficult to consistently add value in that. So you've really got to look for where the inefficiencies are. And I guess that's been my philosophy, is to try and work out where do you actually have some sort of small edge on the market. It might be because you've got specific knowledge about a very specific subset of the fixed interest market, and then you can find opportunities there. So that's kind of been the philosophy. And if you stick to that, then you've got an advantage, and that translates into excess returns for investors.
And have you figured out, for you personally, where your edge is? Like what is it that gives you an edge?
Yeah, look, I think it's just in this relative value area. Just having that focus always on the relative value, and that the direction of the markets is kind of a secondary consideration. If you keep that focus, then that gives you an advantage, and then it becomes with the experience and to a lesser extent the models, but mainly the understanding that you have of the drivers of these small inefficiencies that are there all the time, and you just repeatedly take advantage of them.
Sounds like
again and again.
Building a cricket score on singles.
Well, yeah, that would be a good way of putting it. Yes, we're not going for the sixes here. We're just going for many singles. Yes,
yeah.
Exactly.
So there's been this. We talked about the fact that the bond market is a really great forecaster of. It's very efficient at factoring in future interest rate moves, and there's been this narrative change. Yes. For Aussie rates. Yep. Could you talk me through the moves that are taking place and what your view on what's taking place is?
Sure. So if you look at the August, the market's prediction for where the official interest rate will be in August. So there, by August, we will have had 2 CPI releases. We'll have had the one first and second quarter. They'll have both, that second quarter will have been just released, and then there'll be a RBA meeting soon after that. So the market's got the expected rate at 25 basis points lower than the current rate, so it's expected to be 125 rather than the current 150. So that's what the market predicts, and my take on it probably isn't very much different from that. I'd say there's probably a fairly even chance between by August, after that August meeting, between the rates being unchanged, so where they are, between there having been 1 cut, or possibly even 2 cuts by that stage, because even after the next CPI number, it's quite possible that the RBA could, if it's a really weak CPI number, the RBA could cut then, and then they could wait for 1 more CPI, and they could deliver a second cut. So it's quite possible that there are 2 cuts by then, and roughly equally likely that there's just been 1, or that there's even been 0. So that's what I'd say. It's pretty uncertain. These things, depend on assessments of the economy that are very, very hard to predict. Even the best economists who specialise, and that's all they do for their career, don't get it right very much more than 50% of the time. The best ones get it right slightly more than 50% of the time.
And what about the bond market? How accurate is the bond market from your experience?
Well, the bond market tends to do a better job, is my experience.
So right now, the bond market's factoring in these cuts. You think there's a good chance it's on?
Yeah, well, it's either a better chance of cuts than not, for sure.
Interesting. Do you think they would have much of an impact on do you think they're going to stimulate the economy at this stage?
Well, that's the difficult thing for the RBA, is that the RBA said that they're prepared to cut rates if the data disappoints. So then, if the data does disappoint, they kind of have to follow through and do it. Unfortunately, the reality is that those cuts won't achieve very much in the market. It's mainly to do with it's not to do with the cost of borrowing that's affecting investment, for example, which is one of the missing parts of the puzzle. So, yep, they'll do it, but it will probably only have a minor effect on the economy. Where it does have some effect is it will help weaken the Aussie dollar, which will give a bit of a boost for exporters. That's probably the single most significant effect that it will help have for the Australian economy.
Yeah, interesting. When you were describing what the outlook and the different prints that are going to come through between now and August, you mentioned things like consumer sentiment and CPI data and that sort of stuff. What are some of the economic prints that really matter to you when you're in your role? What things do you see as having a big bearing on bond prices? What are some of the ones that you really follow closely?
Yeah, I mean, there are a lot of economic data releases that, and on an individual by individual basis, it's hard to sort of say one is highly significant. It's really the whole picture that's most important, because each one individual can be kind of noisy and it can give you a false read. But I'd say the top ones are inflation is an important one, because it has that, it's one of the things that the Reserve Banks, it's their job to try and keep inflation steady. Yeah. So that's a very important one. The other one I think that's a good one is the unemployment rate, because that's kind of giving you a sense of whether pressures are building in the labour market, and therefore whether there's inflation pressures going forward. So that'd certainly be the top two.
Those two are pretty tightly linked, aren't they?
Yeah, they are. Yeah, one's kind of they're both a little bit backward looking, but while the unemployment rate is backward looking, because it's obviously to do with the period that's passed, it does have an ongoing impact on what the likely path for wage pressure is, which is quite important from the RBA's point of view for interest rates.
Absolutely. We were chatting a little bit before we got started about Australians' love affair with equities and the challenge of educating them about fixed income and the role that it plays in portfolios. And it's traditionally been seen as that defensive asset class.
Yes.
I read a paper from one of your colleagues just recently that said investment grade risks losing some of those defensive properties at the moment.
Yes.
What's the thesis?
So if you look at through the longer history, bonds and equities have worked for many periods very well together, because you'll find that if you've got both bonds and equities in your portfolio, they'll tend to, the returns from the bond portfolio can to some extent offset falls when the equity market's weak, because what you find is as the equity market weakens, that tends to come with a more sombre outlook for the economy, and that tends to lower interest rates, which gives you an up movement in the bond price. Interest rates down, bond yields down, bond prices up. Yeah. So that's tended to work well. What my colleague Gopi has been pointing out very correctly is that in recent times that relationship between bonds and equities has been breaking down, and you see a lot more periods where you'll actually have them not moving in that traditional benign direction. And it's not, in some ways it's not surprising, because interest rates have been artificially kept low because of the quantitative easing that you were asking about before. The whole purpose of that was to lower interest rates artificially to try and stimulate demand. But one of the unintended consequences of doing that is that you tend to distort some of these more traditional relationships. So what that means for investors is that whereas it used to be the case that you could have equities and bonds and you could feel comfortable that you'd mitigated the risk of your equity portfolio, it's much harder to be confident of that now. And in addition, I think the other point that Gopi's been making very succinctly is that we're also at a point in the cycle where credit spreads are very tight, and where liquidity in the credit market is potentially impaired, partly due to this other thing that we were talking about, the regulation on banks, which makes it hard for them to facilitate transactions than it used to. So when you put all those things together, it's much harder to argue that just any fixed interest portfolio is a defensive one. So what our focus as Ardea has been is to try and build portfolios that have a genuine defensive nature to them. So we do that in rather non-traditional ways, meaning that we'll use certain derivative instruments which are designed to perform well when the market comes under stress, and to avoid the credit instruments which could be badly affected if there's a severe downturn from here.
There's a couple of things I want to follow up in there. First of all, a lot of equity investors are still dusting off the bruises and picking themselves up after what was a really violent bout of volatility at the end of calendar year 18. How were you able, what was the experience like? Did the defensive attributes that you're trying to deliver, did they come through during that period?
Yes, they did. We've had a good period just last few months, partly because of our volatility strategies, where what we do is we buy interest rate options for the portfolios, and that's meant that when we've had some of these sudden and unexpected moves, so for example, when Phil Lowe from the RBA made that announcement that we talked about earlier, you know, the next move isn't necessarily up, it's more evenly balanced between up and down. The interest rates moved sharply and we got a nice one-off benefit from having those option positions in there.
Yeah.
So that's one of the ways, that's one of the non-standard ways that we use to build defensiveness in. It worked nicely in that period. And some other similar strategies which have been exposures in offshore markets have also had some good return impacts recently.
The concept of a relative strategy, relative value strategy, says to me that you, at any point in time, you see assets that are completely overvalued and assets that you believe are undervalued.
Yeah.
Government bonds, is that the primary culprit of overvaluation at the moment?
Well, it's more actually, think more micro than that.
Right.
It won't be necessarily government bonds are expensive and then something else is cheap. It'll be within the government bond market.
A two-year.
A 2 year versus a 3 year could be the type of thing, or even physical bonds versus bond futures. That's been a great opportunity. And other opportunities in the derivative market between various types of derivatives. I already mentioned the options. There are numerous other sort of derivatives that are ripe for relative value. I think one way of looking at it is that the classic way would be you take a bond, you identify a bond that's cheap on some basis, you find some derivative instruments to hedge that bond, to take away the market risk, and then what you're left with is kind of a pure relative value play where you're not trying to predict whether that bond goes up in value in absolute, only relative to the instruments that you use to hedge it with.
Yep.
So that would be the classic example of a relative value strategy.
And from a return perspective, what's the specific target that you're hoping to achieve?
So the fund that we most widely promote is called the Adea Real Outcome Fund. It's a fund that targets about 2% above the sort of wholesale cash rates, and we've recently launched an ETF for that fund. So it's XARO is the code for it, XARO I should say.
Yep.
So that fund targets 2% above the cash rate before fees. So we think that's a good alternative to things like term deposits or to investments in credit instruments. Because while there is some volatility in that return, that 2% return, it's not just cleanly accrued every day. There's some ups and downs, but it's been fairly consistent over the years, the return, and it's also very liquid. So you can, the investors in the fund can have daily access to liquidity, and yet it has these defensive instruments built into it to mean that it's very likely in an extreme poor event to go up in value, which is somewhat unusual for those types of funds.
Ben, we often like to ask our guests to talk us through a mistake or a lesson that they've picked up as part of their journey experience as an investor, maybe one that you learned the hard way that you kind of feel makes you a better investor today. Is there an experience that you can draw on in your formative years when you got something wrong and it's stuck with you again, you'll never make that mistake again?
Well, I should say that when you're a relative value investor, what you do is we said lots of singles before. What that really means is lots of individual relative value positions in the portfolio spread out very thinly. So over any particular point in time, you're getting them wrong about as often as you're getting them right over the near term. What you're hoping is that eventually the cause of the mispricing goes away, and that's when you make your money. So it's often a patience game. You have to spread your bets, and you know they can go wrong, and as long as they're sized modestly, that. So what have I learned? Well, I've learnt when you stray from that, when you say, oh no, this one's a really good one, this one's going to go, and you put too much weight on it, that you learn fast that's it's good just to be modest with them and just expect that, you know, the market is fairly efficient, as we were saying before.
Yep.
And you know, it takes patience and time for these things to work out. So spread your risk carefully is a lesson that I've definitely learned. And but also sometimes it's tempting to think, oh well, no, I feel fairly confident that the direction is this. You know, you sort of think that the market, and if you stray from the relative value investing, I've usually found it hasn't worked out that well.
As a bad outcome.
So it's stick to what you're good at.
Yep.
I think is the key, and certainly in my case, in Ardea's case, because we're all relative value investors at Ardea, it's just sticking to that discipline of modest position sizes and diversification, and just realising that to think that you're smarter than the market and can predict things better, you just want to take those. You by all means have a go, but keep those position size modest because it's very easy to get them wrong.
Final question for you, and again we talked about before, there's somewhat of a lack of understanding or a lack of appreciation or just lack of exposure from Australian investors to fixed income. What do you think the biggest myth or biggest misunderstanding that investors have about investing in bonds is?
Look, I think it's just an area that people don't tend to focus on. And because there are so many aspects to it, not surprisingly, if you're not spending any time focusing on it, then a lot of those aspects will be lost on people because they're just not even giving it any thought at all. So I think it's the lack of attention. I mean, if you look at Europe, there's obviously a bigger pool of savings there, and amongst investors, fixed interest is very widely known and understood. So maybe I think all it will take is for Australia is for these superannuation balances that we have just to grow, and for people to get for the investors to get a bit older and more risk averse perhaps, and then there'll be more investment in fixed interest, and then people will come to know the different aspects of fixed interest. So I just see it as a natural progression of time and of the industry itself.
If the bond market was predicting the outcome of the Bledisloe Cup, what would it tell us?
Yes, I'm not sure the bond market's really capable of doing it, I'm afraid. But
as a Kiwi?
Yeah. As a Kiwi, yeah, I would say Australia's improving, and we've always got to watch out for them. That's what I'd say.
Good stuff. All right, well, thanks for coming in, and great to have a chat about relative value.
Thank you. Pleasure.